Hey everyone, and welcome back to another portfolio update for today. So the Couch Investing portfolio was down 1.58%, whereas the S&P 500 was down 1.41% in the past week. Year to date, we are still underperforming by quite a lot. We're down 16.15%, whereas the S&P 500 is down just over 10%. Since the start of the portfolio, we are still outperforming. We're up 33.87%. Whereas the S&P 500 is up 5.97%. So yeah, not much. I mean, the year-to-date destruction has basically removed quite a lot of gains from the last year or two, which is one thing I want to focus on later in this video. We're also going to talk a little bit more about some macro stuff, and then yeah, maybe some of the things that might change in the portfolio. And as you know, every time we have an earnings season, I do like to add cash to the cash position. Right now, the cash position is basically close to zero. Next time I will be adding more is in the next couple of weeks. So that will stay in the cash position. I don't plan on adding to any position anytime soon, unless something drastically changes in the next couple of weeks or after a specific company reported and I'm like, okay, actually report was good, commentary was good, reaction of the stock market didn't make much sense. So let me add more. But at the moment, the plan is purely to just put cash in the cash position, and that's about it. Now, I do want to touch on some macro stuff and then on, well, the broader, let's say, tech investment team. I don't know what the title of this video is going to be, but as you will see, in the last couple of years, especially if you bought in 2021, yes, very, very specific to 2021 when everything was inflated. But if you look at the last 5-year performance, S&P or NASDAQ from the peak or just before the peak, well, the performance has actually not been that great. So going forward, does it still make sense to pick the big tech companies? Or should you maybe try and look for something else, maybe something less exciting, more boring, but where growth is maybe going to be more stable? Is it time to reset the portfolio? Questions? Well, let's try to answer them throughout the video. If you enjoy this type of videos, hit all the buttons. We really appreciate that. Let's jump right into this. All right, first up, we've had the worst net earnings revisions since 2020. Not surprised, and this is also why I am, well, saying every time and time again, forward PE might look cheap, but when we enter this type of environment, cheap can suddenly become not cheap because, well, forward PE is basically based on what analysts are expecting certain companies to do. So just because a trailing 12 months PE looks very expensive and a forward one looks very cheap does not mean that it will remain cheap. Of course, revisions can go down, but if the stock goes down as well, then the forward PE doesn't really move that much. Now, if we go and look at the cost of timing the market, if you stay invested during all days, and this is basically the value of $10,000 invested in the S&P 500 from January 2003 to December 2022. So yeah, okay, maybe a little bit outdated, but the message here is, well, is the same. If you are invested during all of the days, you're up 548%. If you're missing the 10 best days, you'll be up 197%. If you're missing the best 20 days, you'll only be up 78%. If you're missing the best 30 days, you'll be up 17%. Missing 40 of the best days, you will be down 19%. Missing 50 of the best days, you're down 42%. And if you're missing 60 of the best days, you will be down 57%. I mean, imagine investing for 20 years and actually being down. Not even talking about being down 57%, but imagine being down after 20 years. Unacceptable. Moving on to some inflows and outflows. Well, from European equities, we've actually seen quite a lot of outflows more recently. So have people taken profits because, well, they have been outperforming the US markets year to date? Maybe, maybe not, remains to be seen. Looking at some technicals, let's say, so the percentage of stocks below or lower the Bollinger Band, 73%. We're now at 73% of stocks below or lower of the Bollinger Band or Bollinger Band. And what has happened before when that has happened? 1 week later, well, we should be up 57% of the time. 2 weeks later, 71%, and you're going to be up 71% of the time until 2 months later, and then the odds become better and better. What about the next couple of days? Well, the next couple of days, up until 3 days, 71% of the time, you're up, although on average, nothing much changes drastically here. After 3 days, on average, you're down 1.25%, and only 43% of the time was the S&P green. And then 57, 57, 71%, and 71% of the time 1 month later, where we are up 1.82% on average. So here, yeah, although the odds overall are in our favor, it's not that it's moving the needle that much. Looking at something that has never happened before, quite something, right? We're now at 8 consecutive weeks where the bearish sentiment is above 50%. Has never happened before. So yeah, when we look at, oh, history told us XYZ, well, sometimes history tells us one thing and we make history here yet again. This is one of a kind, never happened before. Another very, very rare case here is the S&P 500 fell this week while the VIX fell at least 7. Well, when did that happen? That happened near the bottom here in 2020. Now, of course, this was the bottom in 2020. You're going to say, oh, is this the bottom yet again? Maybe, maybe not. I think that we did already bottom, but okay, I might be wrong. But the big difference between now and 2020 is that now I highly doubt we're going to be printing out trillions of dollars. So yeah, it might be similar, but it's definitely not the same. Moving on to some job numbers, and more specifically those that hold multiple jobs, we're now at record levels. 8.93 million. 8.93 million people hold multiple jobs, record levels here. Then going back to, well, the expectations for the market, Wall Street banks cut S&P 500 year-end targets. So the red one was, of course, the expectations mid-January, and the blue one is the more updated one. You might say, okay, this is them just following the market sentiment. Yeah, could be, but I'd say it's a mix of that plus, well, some major policy changes as well. Maybe in a month or 2 or 3, those things might change yet again. Definitely possible. And then last thing here, which we'll talk about the major topic of the video. If we look at the most held stocks by hedge fund, number one, 44% is Microsoft, 42% is Amazon, then we have 38% Alphabet, 36% Apple, 36% Meta, Nvidia 34%, so a 10% difference between Nvidia and Microsoft. You have Alphabet here yet again at 32%, those are Class C, no voting rights, Class A with voting rights. That's also basically the difference between the ticker symbol GOOGL and GOOG. Then we've got Visa, JP Morgan, Berkshire, MasterCard, United Health Group, 26% actually. That's quite a big number. Johnson & Johnson, pretty boring but stable company in stock to own, buybacks, dividends. Exxon, 25%. And then number 15 here, Eli Lilly at 25%. Now, let's actually have a look at those top companies, shall we? So if we go, well, Tesla is not included because Tesla is extremely volatile, so I don't think it's worth for them to hold it as of now, although in the last 5 years, the stock is still up close to 400%. But if you look at the top here at the end of 2021, let's say you only bought then, you would still be down. You would still be down 40%. Even if you bought here at the start of 2021, I believe you'd still be down 15% or so 4 years, over 4 years later. Definitely not great. Now with Tesla specifically, margins peaked. Margins peaked back then because, well, 0% interest rate, the cars could be sold for much higher than today. So you have your gross profit margin 25.3%, free cash flow margin 9.3%, and that of course has come down quite a lot since then. Moving on to the second best performer, let's say over the last 5 years, that's Meta. So Meta in the last 5 years is up 163.8%, and since the peak of 2021, still up 32.42%. Now here with Meta, it's the opposite that with Tesla. Here actually gross profit margin stayed around the same, maybe a little bit better. Revenue has gone up. Free cash flow margin has been stable-ish as well, although yeah, in 2021, the big hit happened, which is what has happened right here. Moving on to the next one, that's Apple. Apple is up 178.3%, so that's a bit better than Meta in the last 5 years. But if you look here as well at the peak in 2021, it has only grown by 9.74%. Now, since then, revenue have increased by 6.9%, gross profit margin by 10.6%, and free cash flow margin has increased by 9.5%. So here the business has grown, has improved a little bit, although yeah, it still had or still has actually right now for a business that is not really growing that much every single year. Well, a super high PE compared to the other companies. Moving on to Google Alphabet, in the last 5 years, that's up 139.7%, but here as well, since the peak in 2021, that's only up 2.27%. Looking at the business here, total revenue increased 35.8%, free cash flow margin has actually come down from 26% to 20.8%, gross profit margin is up a little bit from 56.9% to 58.2%. Now, of course, with Google Alphabet, there's this whole, well, first up, is it a monopoly? Is it not a monopoly? Well, apparently it is a monopoly for a specific thing. Then, is search in trouble or not? Some say yes, some say, well, no, because they're getting sued for it. So it's a very, very interesting case with Google Alphabet. I still think it's going to be one of the biggest winners in AI for many, many years to come. But here as well, over the last 4 years, if you bought in 2021, you would be underperforming by quite a lot. Looking at Microsoft over the last 5 years, that's up 110%, but here as well, if you look at the peak of 2021, you'd be up 7.19%. Again, yes, I know I'm very focusing here on the peak. Not everybody is buying the peak. You might be buying actually the bottom in 2022, or you might actually be up 110%, or you could have bought in 2024 and be flat or be down here as well. But Microsoft, since then, total revenue increased by 45.8%. Gross profit margin went from 68.9% to 69.8%, and free cash flow margin did decrease a little bit, lots of investment, capex heavy, so that came down from 33.4% to 30.2%. Looking at Amazon is up 43.25% over the last 5 years, and actually since the peak of 2022, which it peaked a couple of times here, it's actually down 6%. So with Amazon, you might say best company, and I hold it. It's now my number one position, actually. One of the best companies on the planet, in my opinion, but it's down. It's down in the last 4 years, despite revenue being up 35.7%, despite gross profit margin going from 42 to 48.9%, despite free cash flow margin going from negative 3.1 to now 5.2% and improving. So again, here, it's not about buying great companies and that's about it. It's knowing when to buy great companies. Now, like I said, I am focusing here a lot about 5-year period and a specific peak when things were inflated. So here as well, S&P 500 over the last 5 years, up 86.2%, and since the peak back here late 2021, it's actually up 11.78%. Looking at the Nasdaq, that's up 88.6% over the last 5 years. Since the peak of 2021, that's only up 2.68%. Now, this is the point that I'm trying to make. Yes, you might say, oh, look, you bought the peak or didn't buy the peak, but look, you're down. If you look at the comparison, right, in the next couple of months, you're going to see actually the 5-year performance being much worse if we're not really moving from the position that we're at right now. But this is why it's important to stay invested and use the dollar cost average strategy. Because let's say you did buy the peak for all of these names, but you kept on buying every time you saw, okay, the stock is now down even more, business has not really changed that much, the numbers are actually looking good, then your average comes down because you did buy here when it went 20% lower, 10% lower, or with some cases here with Amazon over 50%, or with Meta even more, right? Meta here at the peak went from close to $400 to under $100. So yeah, if you use dollar cost averaging, your average would be much better and your returns would be much, much better than what I'm showing you here right now. And in Meta's case specifically, of course, very specific to Meta, because well, the whole business became just much, much better, you would still outperform quite comfortably, right? You would still be up 32.42% since a peak of 2021, whereas what we've seen here with the S&P or the Nasdaq, S&P is up 11.7%, Nasdaq only 2.6%. So with Meta specifically, you would be outperforming quite comfortably. But the message here is quite clear. I don't think we should reset our portfolio because, well, in the last couple of years, well, it hasn't really performed as expected. We've had some highs, we've had some lows. So if you look at those comparisons, you might say, oh, it was actually a horrible period. But no, it wasn't a horrible period. It was a very, very volatile period. It was a period where we went from, 0% interest rates to then, interest rates going much, much higher extremely quickly, to trillions of dollars being printed, being pushed in the market as well. You add a pandemic to that. You add, specific things that usually never happened. And then after that, the bubble does pop, right? Valuations were sky high. So yes, you get a reset. But again, if you keep investing, even if you buy the top, you can then buy the bottom or be close to the bottom, and then your average is not even near the top. Then when we go back up, of course, it has to be quality businesses, right? This is why I'm showing you these companies specifically. Of course, we can dive into other companies as well. Yes, there are some other companies that are far, far from their, all-time highs or far from the 2021 peak. I mean, if you look at my portfolio specifically, although this is a much newer one, right? The public portfolio is only a year and a half, close to a year and a half old, so I'm not getting the huge impact from the 2021. But my core portfolio, which exists since 2016, which now 90% of it is purely Amazon, Tesla, Meta, Mercado Libre, Google, and PayPal. That's 90% of the portfolio, so it's quite boring. But if you look at these companies right now, right? Since the peak, of course, if you look at the companies like an Intel, for example, a PayPal, a SoFi, an AMD, etc., yes, if you bought the peak and did nothing since, you would still be down an enormous amount, for sure. Now, look at me, for example, PayPal. PayPal is the number 3 position in the portfolio at the moment. And despite it really underperforming the market by quite a lot, I am not down, actually. I'm flat, which is not great. Okay, it's not great. I fully expected PayPal to be much closer to $100, so that's not great. SoFi, for example, was for a long, long time a bad stock, but still is a very, very good company. Still up 31%. Of course, you might be up way more than that if you really timed your buying opportunities very, very well. SoFi was, of course, 70% higher not so long ago, so I could have outperformed quite significantly. Intel is one where I think eventually it will work out. Question is when. And Alibaba, another perfect example. Me, I was lucky. I timed the Alibaba buy perfectly or close to perfection. I am still up 26%. I was up way more than that before April 2nd. But on Alibaba, it was cheap a year ago. It was cheap a year and a half ago. That didn't really matter. Didn't really matter for the market. And the same goes for a lot of other stocks, whether it's in the portfolio or in your portfolio or whatnot. What's important is that, okay, you know what you're invested in. You look at the performance over the last year or 2 or 3, and you might see some good results, you might see some bad results. But it's very, very important to understand why you bought these stocks, why you keep holding these stocks, right? To me, I've seen and I can see a lot of retail's reaction in the comment section. So maybe that's one big advantage of having a YouTube channel, because when I see a comment, oh, I think I'm going to sell this company because I am down 20%. So the first question I ask is always, why? Do you sell because your thesis changed, or do you sell purely because you're down 20%? Because if the thesis has not changed, if the business is still doing what it should be doing, but you are down 20%, then the only thing that went wrong here is the timing of your buys and maybe not buying more when it went down, yet the business performs well, right? If you're down because, the thesis has changed, more competition, maybe CEO change, CFO change, whatever, something bad happened in the company, then that's another thing to discuss. But most of the time, it's purely, oh, I'm down, so I must be wrong, and I would like to sell for something that's up. Usually, that's where things will go wrong in one's portfolio. Now, I know some people will say, oh, what do you know? Look at your portfolio, you're also down this year. Look at your positions, you're also down. Yes, I know very well, which is why I cover this each and every week. When I'm up or down, it doesn't matter. Plus, since this portfolio has started, as you've seen, I am beating the market quite comfortably. Now, I will be the first to admit that the last, I would say, 5 years are not normal years, okay? Since the pandemic 2020 crash has started, up until now, it has not been normal in the stock market. Let's put it that way, right? It has not been normal. We've seen stocks increase 5, 10x, 20x in record time. Usually that does not happen, okay? Just just so we're clear, usually you're getting more boring performance, more boring action in your portfolio and in the markets, right? I don't think that back in 2012 or even when I started back in 2016, it was normal to see a stock go up 20, 25% or down 30, 40% after an earnings report constantly, right? Each and every week we've seen those things happen in the last couple of years. This is not normal. And this usually happens when the markets are inflated, when you are printing so much money, when you go from 0% interest rate to close to 5% in record time, when you have pandemics, when you have bubbles that pop, when you have now trade wars and whatnot. These things are not normal. So taking the last 5 years as an example, going into the future, I think is going to be a mistake. So yeah, we learn from this period, for sure. We learn from every single period, but we do not make silly conclusions and say, oh, this has happened last year, so now I have to change so it doesn't happen next year. No. Again, you invest in the businesses, you invest in the companies that you choose, focus on that. Every legendary investor will tell you, focus less on macro, focus more on the companies and the things that you know and you can control. So all in all, that's about it. Hopefully a useful, good video for you. Do share your thoughts down in the comment section below. Big earnings week coming up as well. We have, I think, Tesla, Intel, maybe even Alphabet reporting in the next couple of days. So stay tuned for all of those videos on the channel. It's going to be one heck of an earnings season. So stay tuned for all of that. Hit all the buttons and I'll see you all in the next one. Bye-bye.